Consumer prices in the US surged more than expected over the past 12 months, signaling a worsening outlook for inflation and cementing the likelihood of more frequent interest rates hikes this year. The Consumer Price Index for January, which measures the cost of dozens of everyday consumer goods, rose 7.5% compared with a year ago. It was the highest reading since February 1982. Stripping out volatile gas and grocery costs, the CPI still increased 6%. Rate-sensitive tech stocks were hit especially hard. The Nasdaq declined more than 2%. Government bond yields also rose sharply, with the benchmark 10-year Treasury note touching 2%, its highest since August 2019. For more on this now, David Madden joins me live from London. He's a market analyst at Equiti Capital. Many thanks for being with us this morning. Inflation expectations, have been rising. So why is the latest reading such a surprise for investors?
I think it's one of those things that it becomes a bit of a self-fulfilling prophecy. People get scared that the price of items is going up, and particularly energy costs are rising because of the pandemic. We also have issues surrounding logistics costs, shipping and transportation, and it quickly becomes one of those situations where people start to think to themselves at manufacturing levels, prices are rising. I don't want to be paying even more for my imported goods or my raw materials 3 months, 6 months, 9 months down the line. I want to buy in as much of it as I can now, which is in a realistic fashion, and all of a sudden that drives up demand. So it's almost as if the fear of higher costs further down the line brings those higher costs closer to us, if that makes sense. So it's ultimately a question of we are all in this kind of upward trajectory of prices, and for the time being, it's showing no signs of slowing down. And when you do have headlines like US headline CPI, it's 7.5%, its highest level in 40 years. That only kind of adds fuel to the kind of the underlying kind of fire, and the belief that manufacturers and industrial houses are going to be kind of even more keen to get raw materials in the door sooner rather than later.
Absolutely. And what sectors of the real economy, but also of capital markets, are most likely to benefit from higher interest rates, and who is losing?
Not many benefit from higher interest rates. The banking sector is a sector which benefits from a higher interest rate environment. It essentially all revolves around the yields on government, the yields on bonds, and the yields surrounding lending. So if bond yields are moving higher, which they are, the US 10-year yield yesterday hit 2%, its highest level since July 2019. In a higher interest rate environment, or a perception that interest rates are going to rise, as you mentioned in your intro, we could be looking at up to 7 rate hikes from the Fed this year. Banks will benefit greatly from this because their lending margins will improve. Also, investment companies and pension groups, in terms of the yields they get for their investors, they're likely to stand to benefit. But the rest of us are in a minority. Everything from retailers to the airline sector and the food and beverage sector, we're unlikely to actually feel the downside of higher costs, and margins will be squeezed at the vast majority of sectors. It's only really the banks and pension fund managers that will actually benefit from higher interest rates, which is usually a product of higher inflation.
Interesting. David Madden, thank you for being with us this morning.
Thank you.